Good morning, everyone. My name is Ennio Titorenko. I am a mortgage broker, also broker owner to Next Gen Mortgages, Dominion Lending Centers. And today I'm going to talk to you about some mortgage stuff. Some basic economic overview of where the mortgage landscape is right now. Some things that will, be directly integrated with you and your business. And then I want to go through some deal killers because I've had a few hairy experiences over the last, call it year and a half that I would love to share with you. We are here locally, also licensed right across Western Canada. So we've got an office in Langford. We've also got an office in Manitoba and Saskatchewan. So for all of your clients moving cross-provincially, I can work with that as well. So I've been hearing a lot of different things. I personally am experiencing the heat. Things are moving, people are buying, on my end, lots of refis, renewals, people accessing equity to gift. There's lots of action happening, but I'm also hearing about the opposite end of the spectrum where, people are saying the market's dead, it's slow, it's difficult. So I just kind of want to say that it's probably less forgiving. Interest rates have stabilized. In the last two and a half years, we've come from quite a steep rate environment. Prime rate went absolutely crazy through 21 to 23, capping out at, I think it was like a 7.25% policy rate at the Bank of Canada, down to prime rates 4.45%. So a lot of movement. Prime rates dropped substantially and fixed rates have come down as well. But that's not really meaning that people have any more incentive to buy. Right now, we can all recognize it's a great time to buy. Rates are stable, but for some reason, there's a lot of people on the sidelines. And I would just like to say that that's just consumer confidence. It's never been lower. World economics, geopolitical economics have people on the edge of their seats, just constantly uncertain. So that's really playing a factor into people making a decision on investing in the largest asset of their lives. And lenders, over the last 3 years, lending has gotten even more restrictive. Things are getting more scrutinized. Exceptions that I used to be getting aren't as easy to get. Things are getting reviewed in a lot tighter of a scope, which I think is just reflective of everybody's overall uncertainty. But Victoria specifically, buyers are active, but more selective, a little cautious. Sellers are finally adjusting expectations, coming back from their, peak, stuck at 2023. I think people are starting to get a lot more real with what they can get. Not always fast enough. We still see things sitting on the market for quite a long time. And condos and townhouses, of course, are moving very slow, arguably at the lowest point they've been in a very long time. So I find that precision is what's really mattering right now. Pricing correctly, aggressively, having those conversations, knowing your client really, really well will help deals move quicker, more efficiently. So April 2026, current rate and economic environment, Bank of Canada has held their policy rate for this year and actually 2 holds towards the end of 2025 as well. So we've seen prime rate stay the same. Now, when you hear people talking rates moving, rates going up, rates going down, that's almost all the time in respect to prime rate. When people say rates are going up, rates are going down, it's usually not even reflective of fixed rates. Prime rate and fixed rates move on completely different planes, different variables, and I'll speak on that in a second, but rates have stayed pretty stable over the last, call it 8 months. Inflation has cooled. That's also a big factor as well. We've come down from a really steep inflationary point over the last 3 years to leveling out. And also other factors are Canada's in a lot of ways on the edge of a recession. GDP growth, the job market's stunted in a way. So there are a lot of factors that have also played into rates holding. And the future expectation is that we see more holds, possibly even drops later this year. And nothing aggressive, like not a lot of movement. Nothing's gonna happen quickly, but just been pretty stable. Sticky core inflation in shelter and services, rising unemployment, and ongoing global economic uncertainty are also keeping the Bank of Canada really cautious, keeping rates held the same. They don't want to drop them too quickly and spur inflation. They also don't want to increase them and put the average Canadian at a further point of unaffordability than what they are right now. Now, like I said, variable rates, prime rate has stayed really stable, but fixed rates, on the other hand, have been moving quite a bit in the last even month. Come down in a huge way over the last year, from beginning of 2025 to now, come down quite a bit. We saw fixed rates for an insured mortgage that average was about 3.8 at their lowest. Now we're up to 4.39. And you might be wondering, why would they go like this and up and down and stable and up and down? Fixed rates move based on the bond yield, and lots of factors go into what impacts the bond yield, but the global political economics have been the biggest factor into creating an unstable bond yield. And funny thing is is uncertainty. Just the concept of uncertainty is what's impacting the bond yield right now. Even though we didn't have tariffs put into place, or weren't really experiencing direct costs during that whole trade war that was going on last year. They ended up going into place in the later half, but from the very beginning, our bond yield was going like this, up and down, and based on what the big guy said, it would go down a little bit, give everybody a little bit more, calm their nerves, and then you'd say something crazy and then it'd go back up. But literally just the concept of uncertainty is what's impacting fixed rates in a really big way right now. So in the last 3 weeks, we've seen them go from low fours to mid fours, just like that, just based on the Iranian-Israeli war. Another factor, employment growth has slowed compared to previous years. GDP growth is low, consumer confidence remains cautious and frankly low, and of course borrowers are still qualifying based on stress testing. That's nothing new. The forward outlook, probably not a lot is going to change. The expectation is that rates stay relatively stable. At the end of the day, if we've got variable rate down here and fixed rates are doing this, if someone wants to qualify for the max qualifying power, they're going to choose a variable rate. So qualification isn't necessarily being hugely impacted with the fixed rate turbulence. And any cuts that we do see this year are going to be gradual, not aggressive in any way. What this means for you guys, buyers are being very payment focused. Sellers need a lot of expectation setting. Mortgage penalties are very real. So of course, it sounds pretty common sense, buyers are payment focused, but we're seeing that be the core of somebody's interest right now. Another factor that I spoke on in a video a couple months ago is in Q1, they released the consumer high interest debt is extremely high in Canada right now, much higher than it's been in previous years. That paired with, gas prices shooting through the roof, food prices being really high, people are feeling it. People are feeling the pinch, they're tight, things are relatively unaffordable right now. So, payments are a huge deciding factor. Looking at that 30-year AM, looking to get those rate exceptions, those discounts, going for the variable rather than the fixed, even though that means conceptually more uncertainty in the future. You can mitigate that risk with a lot of review of our economic state, forward planning, like I said, based on a ton of variables. The expectation amongst the mortgage industry is that prime rate stays the same, doesn't move too much. Sellers need expectations. You guys are great at doing that. I don't need to go into depth. Pricing, timelines, negotiating flexibility all matter a ton, but something that's really impacting sellers right now are penalties. Because we're coming down from a really high fixed rate environment, 2 years ago, we were at 5.7 for a conventional uninsured mortgage. So that's any mortgage, any purchase made over $1 million with more than 20% down, or any purchase made over 1.5 in general, you're falling into this uninsurable conventional category. Those rates were really high, and as we all know, those are the prices here. If we're talking big banks like BMO, TD Scotia, their interest rate differential penalty calculation is going to be quite high. Reach out to me if you want me to do that really convoluted calculation for you. But long story short, people in the middle of their term breaking the mortgage with a big mortgage in what's definitely going to be a conventional price point, they're going to be looking at quite a high penalty. So that's definitely something to factor in when you're looking at closing costs, and also just the overall tightness of maybe moving from one property to another when you're taking funds from the sale to move into a purchase or possibly downsizing. Definitely seeing some of those penalty calculations come into the $10, $20, $30, $40, $50,000 mark. If it's a B lender, could even be higher. And a lot of us work with self-employed people that wanted to get into the market. So just be conscious of penalties, have that conversation with your client. Who's your lender? What's your rate? What's your term? All these different factors. So the Victoria market reality, local conditions you guys are working in, increase in inventory, of course, very high compared to previous years. Conditions are closer to balanced, definitely not seller dominated. Some would argue that it is a buyer's market. Price growth has stabilized. We're still seeing the single family detached go pretty quickly. That's definitely not a problem. There's not more land to be created. So the single families are definitely going, but the townhouses and condos are definitely feeling it aggressively, and I'm sure you guys are lowballing the heck out of each other on all of the townhouses and condos. And of course, conditional offers are common again. This is almost a forgotten time, but anybody that went through 2020, 2021 would have experienced just madness, where unconditional, no inspection, 3 weeks to close was almost common, and that's what we were all dealing with. But now it's again more buyer-centric, buyer-focused. We're getting 2 weeks for financing, inspection, all the conditions. If we need to add a co-borrower on mid-contract, price adjustments. It's just a very flexible time. Buyers are taking more time to evaluate their options, running you guys all around the city, looking at 10, 20, 30 different homes to make sure they're making the right decision. All right, that's your favorite part. So understanding financing in general really allows you guys to get structure, cleaner, more competitive offers, set realistic client expectations, in tandem with the broker, navigate negotiations a little more effectively, and differentiate yourself as just that edge, a little bit more knowledgeable than the average agent.